Hello, Finance Virtuosos. In today's video, I'm going to tackle one of the most common and controversial questions in personal finance. Should you use your income to pay off debt or invest? This is a dilemma that many people face, especially those who have student loans, car loans, credit card debt, or mortgages. The decision can have a significant impact on your financial future, so it's important to weigh the pros and cons carefully. So, let's dive into the details of this debate and see what factors you should consider before making your choice. This is the Finance Virtuoso channel, where we talk about all things finance. For your daily dose of valuable information on money, business, investments, and savings, be sure to hit the subscribe button and click the notification bell right now. The math behind the decision. The first factor to consider is the math behind the decision. This involves comparing the interest rate on your debt to the expected return on your investment. The general rule of thumb is that if the interest rate on your debt is higher than the return on your investment, you should pay off the debt first. This is because you will save more money on an interest than you will earn on your investment. For example, if you have a credit card debt with a 20% interest rate and you expect to earn a 10% return on your investments, you will be better off paying off the debt first, as you will save 10% on interest. However, if the interest rate on your debt is lower than the return on your investments, you might be better off investing first. This is because you'll earn more money in your investment than you'll pay on interest. For example, if you have a mortgage with a 4% interest rate and you expect to earn a 10% return on your investment, you might be better off investing first, as you will earn 6% more on your investment. Of course, this is a simplified calculation that does not take into account other factors, such as taxes, fees, inflation, and risk. Depending on your tax bracket, you might be able to deduct some of your interest payments from your income, which can lower your effective interest rate. You might also have to pay taxes on your investment gains, which can lower your effective return. Additionally, you have to consider the fees associated with your debt and your investment, such as origination fees, maintenance fees, or transaction fees, which can eat into your savings or earnings. Furthermore, you have to account for inflation, which can erode the value of your money over time. And finally, you have to factor in the risk involved in your debt and your investment, such as the possibility of defaulting on your debt or losing money on your investment due to market fluctuations. The psychology behind the decision. The second factor to consider is the psychology behind the decision. This involves understanding your emotional and behavioral tendencies when it comes to money. Some people are more comfortable with debt than others, and some people are more comfortable with risk than others. Depending on your personality, you might prefer to pay off debt or invest first, regardless of the math. For example, some people might feel stressed, anxious, or overwhelmed by having debt, and they might want to get rid of it as soon as possible. They might value the peace of mind and freedom that comes with being debt free, and they might be willing to sacrifice some potential returns on their investment to achieve that goal. These people might prefer to pay off debt first, even if the interest rate is low or the investment return is high. On the other hand, some people might feel motivated, optimistic, or ambitious by having debt, and they might want to leverage it to grow their wealth. They might value the opportunity and potential that comes with investing, and they might be willing to take on some risk and interest to achieve that goal. These people might prefer to invest first, even if the interest rate is high or the investment return is low. Of course, this is not to say that one personality type is better than the other, or that you should ignore the math completely. Rather, it is to acknowledge that money is not only a rational matter, but also an emotional one, and that you should be aware of your own preferences and biases when making your decisions. The balance between the two. The third and final factor to consider is the balance between the two. This involves finding a middle ground that works for your situation and goals. While the math and psychology can provide some guidance, they are not absolute rules that apply to everyone. There might be cases where you can benefit from both paying off debt and investing, or where you have to prioritize one over the other depending on your circumstances. For example, you might want to pay off some of your high interest debt first, such as credit card debt, before investing, as this can save you a lot of money and reduce your financial stress. However, you might also want to invest some of your income, especially if you have access to a 401k plan with an employer match, as this can provide you with free money and tax advantages. You might also want to invest some of your income in a Roth IRA, as this can provide you with tax-free growth and withdrawals in retirement. You might also want to invest some of your income in a taxable brokerage account, as this can provide you with more flexibility and liquidity than a retirement account. Alternatively, you might want to invest most of your income first, especially if you have low interest debt, such as student loans or mortgages, and you expect to earn a higher return on your investment. However, you might also want to pay off some of your debt, especially if you have a variable interest rate, or if you're approaching a major life event, such as buying a house, tying the knot, or having a child. You might also want to pay off some of your debt to improve your credit score, which can help you qualify for better rates and terms on future loans. The bottom line is that there is no one-size-fits-all answer to the question of whether to use your income to pay off debt or invest. The best decision depends on your individual situation, goals, and preferences. However, by considering the math, the psychology, and the balance behind the decision, you can make a more informed and confident choice that suits your needs. What are some of your own strategies for paying off debt or investing? Let me know what you think. And before you go, don't forget to hit those like and subscribe buttons. See you in the next video.